We are approaching an extremely important time right now in terms of, yes, the stock market and investing, single companies, crypto, all that stuff, but also just in terms of the real economy and the safety of our jobs, because we have the Fed meeting coming up this week where they are deciding the next change in the interest rates, which are the baseline interest rates in the economy, and everything is priced from there. And maybe a small change to our mortgage rates is not the biggest deal, but when we kickstart a interest rate cutting cycle, because we've been on break for around 9 months, that's when we expect to see a lot of volatility. So if we do see the Fed cut interest rates in the next week, then until around June of next year, we could expect maybe a 20% move higher in the stock market, or maybe a 20% lower move. That's the type of volatility historically that we tend to see. And the biggest indicator of whether we're going to see a positive return in our stocks and the economy or a negative situation is all to do whether we're going into recession. What's the real economy doing in the next 12 months? However, before we get into that macroeconomic data in today's video, let's just confirm what exactly the Fed has planned for us in the next really year. So having a look here, in the next meeting, we have a 94% chance of a 0.25% cut and a 6% chance of a 0.5% cut. That's really priced by the treasury market and kind of betting odds all mixed in. But if we take a longer term view to this picture, it really shows a clear pathway where we expect about a 0.25% cut in that baseline interest rate every single meeting. Those meetings happen around every 6 weeks, and that's likely to continue all the way through to the end of 2026, where we're pricing in a 2% Fed funds interest rate. We've got this idea of a potentially stronger or weaker economy, therefore affecting what's going to happen to our investments. And I think that's flipped in a lot of people's minds over the last couple years. They think that they see all-time high prices in tech companies like Microsoft, Google, Facebook, Amazon, Nvidia. Those are fantastic companies growing profits more than 20% per year, but that's only because we've had a relatively strong economy really since 2022. People might say that they've been struggling for a long time, but really the top 60% of people have been doing pretty well, especially on a whole macroeconomic scale. If you add in the $1.5 trillion US government deficits, along with the trillions of dollars that have been spent by big tech companies and trying to upgrade the infrastructure of America, trying to implement AI. There's a huge amount of dollars flowing around America. That money might dodge a lot of people and you don't feel rich, but there is a lot of wealth being transferred around us. And that is going to keep powering the economy and the stock market higher. But I do also see that argument of middle America or people not associated with big tech struggling. And we can see this in a few different stats. Now, in terms of GDP growth, we only have official numbers for the first quarter of this year. And of all of the states of America, only 10 states in the first quarter experienced growth. And pretty much all of those states, besides one, I think, were located in the traditional southern states, and that was mainly due to strong population growth. But I also have an updated list, and this comes from the Fed itself. Now, they cut up the United States into 12 different Fed districts. 4 regions mentioned meager growth or slow growth. Those were Boston, Philadelphia, Cleveland, Richmond, and Chicago, very much centered in the Northeast. And the only district that reported moderate growth, not fantastic, just moderate, was Dallas, which is centered around Texas. Now we see there's a huge amount of America that is experiencing weak growth. If you just drew a line all the way down from pretty much Chicago diagonally down to about Dallas, everything west of that line is just not doing that well. Some people are saying California is doing all right, but I definitely wouldn't be putting them in a strong economic growth category. At a certain point, we all need to decide whether we're going into recession or we're going to see a stronger economy or just even moderate. And I've got a few different stories here to help us decide. So we have a story here of a cloud business called Oracle. Now, usually they just sell cloud business services, all the usual stuff to a lot of companies all around the world. They are owned 40% by Larry Ellison, who as of yesterday is now the richest man in the world, overtaking Elon Musk. Oracle as a company went up 40% in a single day and made Larry Ellison around $100 billion just for him. Now, why did Oracle go up so much in stock price? Well, it's because they had a pretty cracking quarterly report. Oracle has gotten involved with building AI data centers. That's the computing power behind all of the AI services you access online. They focus on a particular application and they build the computing power that specializes in AI inferencing. So there's two really types of categories. You have AI training, which is building up the model. That model being created from scratch and getting better is AI training. And there is a very clear transition that's happening in terms of training AI models over the past few years. And we are now moving towards AI inferencing, the actually doing and delivering of the AI product. And there's a few major applications that's making inferencing more and more popular. Just for one example, we have Oracle making a deal with OpenAI's ChatGPT worth around $300 billion. Now, Oracle is going to do the AI inferencing for OpenAI, particularly around AI agents. Now, what the hell is an AI agent? Well, think of it as a personal assistant you can program. Very good for small businesses or maybe organizing your personal life. Instead of paying a personal assistant 50, 60 grand a year, maybe a virtual one overseas for 20,000 a year, you could use your AI agent to help do your logistics. You sell t-shirts as a small business. It does the labels and organizes how it's going to move from your warehouse to that customer's house. And ChatGPT needs those inferencing data centers from Oracle in order to process all of our requests. Oracle now has a backlog of business associated with AI and data centers to the tune of $455 billion US. That was reported a few days ago and was a 359% increase. But those aren't the only companies that are seeing a huge increase in terms of people accessing and paying and using AI services. We have Google, Amazon, and Meta. They're growing revenue somewhere around 30% per year. And that means a few extra $100 billion a year going into AI, building out data centers, paying for people's jobs that work for these tech companies. And all of that does shift the needle in terms of total economic growth and the health of the American economy. Unfortunately, that's pretty much the only positive news piece I've been able to find over the last few weeks. We've got a few other things coming in on the negative side, especially about the average Joe experiencing economic difficulty. To help make this negative section of the video a little less dark, I've started off here looking at some kind of funny but kind of dark Google trends. Now, the line is just showing the popularity of people searching these key terms, but we have things here like selling my house fast, give my car back, borrow against stock, bankruptcy lawyer, and borrowing against life insurance. I'll just say that as the last one there. Holy crap, that's dark. But overall, we're getting this picture of a spiking up in people not being able to afford everyday life anymore. We've also seen some interesting news in terms of the jobs market, with a very clear downward trend in total jobs gained in America ever since the lockdowns were lifted in 2021. In the last 4 months alone, we've only seen an average of 27,000 jobs gained per month. I would say that's roughly a factor of 1/10 of where we should be seeing jobs gained in a strong economy, roughly between 100 and 200,000. That's where you would see a decent level. 300,000 jobs gained, a very strong economy, and we're just very far from that right now. If anything, we're starting to approach recessionary territory, at least when we're looking at jobs gained. But not only that, we have some extra data in terms of job revisions. That means the government looks back at the last 6 months, has a look at their total jobs they said the economy gained, and realize they've made a few mistakes. They get some late survey results, people don't get back to them in time, and we've seen 911,000 jobs lost from March 2024 all the way through to March 2025. And this tends to happen when the economy is on a downward trajectory. It uses algorithms and just averages to try and predict, okay, we only got like 10% of the surveys back. Let's just guess what the other 90% of respondents would say. The algorithm just spits out a number and that's what they use. If the economy is going downhill, getting worse every month, then that algorithm, those averages, are always going to say a higher number than what the reality is. And if that continues to be true, we could be firmly in negative jobs gained territory, which again tells us we might be in recession already. I've got one last final indicator to go through today in order to help us understand the economy right now, and it's about total construction spending. Now, we've gone recently from a very strong situation. 2023, 2024 early, we had about a 10% growth in construction spending year over year. But in the last 6 months especially, we have just slowly fallen off a cliff. Now we're seeing a 3% decline year over year. That might not sound very impressive, 10% growth to a 3% decline, but that size drop happened right before the GFC, a very, very bad recession, one of the worst since 1929. In terms of just an average or shallow recession, around 2000 to 2003, we only saw around 2/3 of the drop in construction spending compared to the recent one we have just experienced. The potentially scary part about this is it's more of a forward indicator. There's lots of jobs associated with construction, and if you spend the money, then usually the job takes a while to actually finish and happen. But either way, construction spending is a great barometer of the health of the economy, and it's heading in the wrong direction. So you can have a think with all of that information today, plus everything else you've seen. Do we look like we're in a strong economy or a weaker economy? And if we tie in that picture of interest rates, that just multiplies whatever move we were going to see. It's going to make the increase a lot higher, but also make the drop feel much worse. Personally, I'm still investing my money right now. So you can see here, I'm not afraid of taking risk, but I'm also not just putting 50% of my money in Bitcoin or 50% of my money in a high risk stock like Duolingo. It's nice diversification, got some healthcare, got some Berkshire Hathaway in order to ride out any storms.